for things just happened, and almost nobody is connecting them. First, tariff escalation rhetoric moved from negotiation language to enforcement language. Not proposals, not leaks, direct signaling. Second, a 10-day geopolitical ultimatum was issued in the Middle East, placing a hard clock on a region that sits at the heart of global energy flows. Third, gold and silver didn't just rise. They moved with abnormal positioning behavior in futures and options, the kind of activity that suggests preparation, not reaction. Fourth, sovereign bond yields refused to collapse despite risk headlines, which means capital is not simply hiding. It's reallocating. Those events occurred within a 24 to 48-hour window. Individually, each headline looks manageable. Together, they form a pressure system. And here's the part most coverage is missing. This is not about fear. This is about structure. Tariff escalation reintroduces supply chain friction at a time when global manufacturing margins are already thin. An Iran-linked deadline introduces energy uncertainty into a system still dependent on stable oil corridors. Meanwhile, precious metals aren't behaving like panic assets, they're behaving like strategic assets. That distinction matters. Gold did not spike in isolation. It firmed alongside selective dollar resilience and uneven bond response. Silver didn't just follow gold. It outperformed at key moments intraday, a tell that industrial and speculative flows may be converging. Options activity suggests upside protection demand is increasing, but not in a disorderly way. Call spreads widened. Open interest shifted further out on the curve. That's positioning. This is not retail chasing headlines. This is capital adjusting to regime risk. Because when tariffs escalate, import costs rise. When energy routes destabilize, input volatility rises. When both occur simultaneously, central banks lose flexibility. And when policy flexibility compresses, metals reprice. Not because of crisis, because of constraint. Now, add one more layer. If geopolitical risk expands while trade tensions intensify, the Federal Reserve and other central banks face a policy dilemma: tighten into inflationary pressure or ease into currency weakness. Either path benefits hard assets over time. That's the macro compression forming beneath the surface. By the end of this video, you're going to understand why this moment is not just another headline cycle, but potentially the early phase of a repricing window in gold and silver that most participants will only recognize in hindsight. You're going to see how policy escalation, energy risk, mining margins, dealer inventories, and derivatives positioning are beginning to align. You're going to understand why volatility in metals is not random right now. And you're going to see why the next 6 to 24 months may look very different from the last 18. Because markets don't move on headlines. They move when structure shifts. And structure is shifting. The tariff escalation signals fragmentation. The 10-day ultimatum introduces a timing catalyst. Metals are absorbing capital, while equities remain selective. Bond markets are conflicted. That cross-asset divergence is not noise. It's tension. And tension resolves. The mainstream narrative is treating these developments as isolated geopolitical drama. But markets don't isolate. They integrate. Tariffs affect manufacturing input costs. Energy uncertainty affects transportation, chemicals, and global trade pricing. Currency markets react to policy response expectations. And metals sit at the intersection of inflation risk, currency hedging, and sovereign distrust. This is not about predicting war. It's about recognizing fragility. Because when multiple pressure points activate simultaneously, markets begin pricing optionality. Gold is optionality against policy error. Silver is optionality against industrial constraint and monetary spillover. And both are beginning to reflect something deeper than daily volatility. The question isn't whether headlines are dramatic. The question is whether capital is repositioning for a regime shift. The early evidence suggests it might be. Let me show you why. Policy escalation and government action. Let's start with the policy layer, because that's where regime shifts begin. The tariff escalation is not simply political theater. When trade rhetoric shifts from negotiation to enforcement, markets begin pricing cost transmission. Tariffs are taxes. They raise input costs for importers. They compress margins for manufacturers. They ripple into consumer pricing if passed through, or into earnings compression if absorbed. Now, layer that on top of an already fragile global supply chain environment. Global manufacturing PMIs have been hovering near contraction thresholds in several major economies. Margins are thinner than they were during the 2021 to 2022 stimulus cycle. Corporate pricing power is not what it was. If new tariffs are implemented or even credibly threatened, companies must hedge supply exposure. That hedge often takes three forms: inventory front-loading, currency hedging, hard asset exposure. Gold historically benefits during periods when trade fragmentation increases because it functions as neutral collateral. It is not someone else's liability. Now, add the geopolitical layer. A 10-day ultimatum in the Middle East, particularly involving a country positioned near critical oil transit choke points, introduces energy optionality risk. Roughly 20% of global oil trade flows through the Strait of Hormuz. Even the perception of disruption can lift energy risk premiums. Higher oil doesn't just mean higher gas prices. It means higher transportation costs, higher petrochemical input costs, higher fertilizer costs, higher embedded inflation. If tariffs raise goods prices and energy risk raises input volatility simultaneously, central banks are trapped between inflation persistence and growth fragility. That trap is gold positive. Not because central banks panic, but because their room to maneuver narrows. When policy flexibility compresses, real yields become unstable, and gold trades on real yield expectations more than nominal rates. Silver then adds a second layer: industrial exposure. If trade fragmentation accelerates regionalization, think reshoring, defense production, energy infrastructure, silver demand can rise structurally due to electronics, solar, and industrial components. So policy isn't just geopolitical noise. It's the ignition source. And ignition changes volatility regimes. Corporate earnings and miner signals. Now let's examine the miners, because miners often telegraph stress before spot markets do. Recent earnings reports from major gold and silver producers showed something interesting. Realized prices were strong. Margins improved relative to the prior year. Yet guidance language was cautious. That divergence matters. If spot gold is firm and miners are realizing elevated average prices, why the hesitation? There are two primary explanations. First possibility: cost inflation. Mining is energy intensive. If diesel prices rise or labor costs increase, margins compress even when spot prices are strong. Second possibility: capital discipline and uncertainty. Management teams may anticipate volatility ahead, either in input costs, currency movements, or geopolitical disruptions affecting supply chains. Which explanation is more likely? Energy sensitivity suggests the first explanation carries weight. Diesel and equipment costs are directly tied to oil. If Middle East risk lifts crude volatility, miners face rising operating expenses. But there's a deeper layer. Several miners increased hedging activity in recent quarters. That indicates a desire to lock in cash flow stability. When producers hedge aggressively, it often signals forward uncertainty. They are not betting against gold. They are protecting balance sheets against macro instability. And historically, when miners hedge into strength while spot continues climbing, it suggests institutional capital expects volatility, not collapse. Silver miners show an even tighter squeeze. Silver production growth has lagged demand growth in certain years due to underinvestment and declining ore grades. If industrial demand remains firm and geopolitical stress increases investment demand, silver's supply elasticity is limited. That's when price acceleration can occur. Miners, in short, are not euphoric. They are cautious. Caution from producers during rising price environments usually signals structural uncertainty, not weakness. Physical market evidence. Now move beneath paper markets into the physical layer. Dealer reports in recent weeks indicate elevated retail coin demand relative to seasonal averages. Premiums on sovereign coins have widened modestly, not explosively, but noticeably. That suggests steady accumulation rather than panic buying. Shipping timelines for large wholesale bars remain manageable, but some international hubs show minor delivery delays. This is not a squeeze. It is a tightening. Industrial buyers have also been active. Solar panel demand continues to support silver offtake. Electronics manufacturing, while cyclical, has stabilized. If tariffs accelerate domestic production incentives, industrial silver demand could become more regionally concentrated, tightening available export supply. Now, consider international pricing divergence. In times of stress, gold often trades at a premium in certain regions relative to London spot. We've seen intermittent divergence patterns emerge during geopolitical stress periods before. These are early indicators of localized demand spikes. Again, not panic, but preparation. The physical market is not screaming shortage. It is whispering accumulation, and whispers precede noise. Derivatives, futures, and options pressure. Now we reach the most misunderstood layer. Derivatives. Open interest in gold futures remains elevated relative to historical norms. But what matters more is the ratio of paper contracts to registered physical inventory on exchange warehouses. The leverage ratio remains high. In some periods, there are 20 to 30 ounces of paper claims for every ounce of registered deliverable inventory. Now that does not mean default. It means most contracts are cash settled. But during volatility spikes, even a small percentage of participants demanding delivery can stress liquidity. Options positioning adds nuance. Recent data shows increased call option activity further out on the curve, not just near-term weekly speculation. That implies structured positioning rather than retail chasing. Call spreads widening indicates participants are positioning for upside while managing premium risk. Silver options have shown episodic gamma pressure during rallies, meaning dealers hedging short calls must buy futures as price rises. That can amplify upward momentum. Delivery math clarifies the difference between probable and theoretical. If 5% of open interest demanded physical delivery simultaneously, warehouses would strain. That scenario is unlikely under normal conditions. But during geopolitical compression and policy uncertainty, tail probabilities widen. Markets price tails before they materialize. And gold, especially, trades as a hedge against tail risk. So derivatives positioning isn't predicting collapse. It's reflecting increased demand for upside convexity. Convexity becomes expensive when volatility regimes shift. Connecting the threads, now step back. Tariff escalation increases cost pressure. Geopolitical deadlines increase energy risk. Energy risk increases input volatility. Input volatility constrains central bank flexibility. Constrained central banks destabilize real yield expectations. Unstable real yields support gold. Meanwhile, miners hedge cautiously. Physical markets accumulate steadily. Options traders position for structured upside. Industrial silver demand remains resilient. These are not isolated data points. They are converging signals. Is collapse guaranteed? No. Alternative explanations exist. Tariff rhetoric could de-escalate. Geopolitical tensions could cool. Energy flows could remain uninterrupted. If that happens, metals may consolidate rather than accelerate. But markets are not pricing certainty. They are pricing asymmetry. Right now, the asymmetry favors hard assets as portfolio insurance. Gold is absorbing sovereign uncertainty. Silver is straddling industrial resilience and monetary hedge demand. The convergence of policy friction, geopolitical timing, producer caution, physical tightening, and derivatives convexity suggests we may be entering a higher volatility metals regime. Not necessarily a vertical spike, but a structural repricing window. The next move will not be determined by headlines alone. It will be determined by whether policy fragmentation becomes persistent. If trade blocs harden and energy corridors destabilize, capital will continue seeking neutral collateral. And gold has functioned as neutral collateral for 5,000 years. Silver adds torque to that thesis due to its dual role. This is not about panic. It is about probability. When multiple macro stress vectors activate within a compressed timeframe, capital reallocates. The early signs of that reallocation are visible. The question is whether they intensify or fade. And that is where the next phase begins. Let's compress this down to the 4 strongest signals. First, trade escalation rhetoric shifted from negotiation to enforcement language. That changes corporate planning behavior immediately. Companies hedge. They front-run costs. They protect margins. Second, a hard geopolitical clock was introduced in an energy-critical region. Not vague tension, a defined time horizon. Markets react differently when uncertainty has a deadline. Third, miners are profitable at current prices, yet cautious in guidance and hedging activity. That tells you volatility expectations are rising beneath the surface. Fourth, derivatives positioning shows structured upside exposure building in gold and episodic gamma pressure in silver. Not chaos. Preparation. Individually, none of these guarantee a breakout. Collectively, they suggest regime tension. Now, what does this mean for the next 6 to 24 months? If tariff escalation becomes policy reality rather than rhetoric, global supply chains fragment further. Fragmentation raises costs. Higher costs increase inflation stickiness. Sticky inflation restricts central bank flexibility. If geopolitical risk intermittently lifts energy volatility, that amplifies input instability across manufacturing, agriculture, and transportation. In that environment, real yields struggle to anchor. And when real yield stability erodes, gold tends to reprice. Not necessarily in a straight line, but structurally higher. Silver then becomes the torque instrument reacting not only to monetary hedging flows, but also to industrial demand shifts tied to energy infrastructure, defense production, and reshoring initiatives. That's the constructive scenario for metals. But alternative outcomes exist. Tariff rhetoric could de-escalate through negotiation. Energy tensions could cool before any supply disruption. Central banks could successfully engineer a soft landing, maintaining credible inflation control while supporting growth. In that scenario, metals may consolidate rather than accelerate. Volatility could compress. Speculative positioning could unwind without structural damage. That's why this isn't about prediction. It's about mapping probabilities. Right now, the probability distribution is widening. When macro distributions widen, portfolio insurance gains value. Gold functions as monetary insurance. Silver functions as both monetary and industrial leverage. Neither requires panic to justify ownership. They require constraint. And constraint is building in trade policy, in energy risk, in monetary flexibility. The key takeaway isn't that a crisis is imminent. It's that structural pressure points are aligning in a way we haven't seen in several quarters. Markets don't wait for certainty. They reprice when asymmetry appears. And asymmetry emerges when policy, geopolitics, corporate behavior, and derivatives positioning begin pointing in the same direction. That alignment is early, but it's visible. For long-term capital allocators, the question isn't, will gold spike tomorrow? It's, is the macro regime becoming less stable? If the answer trends toward yes, hard assets quietly become more relevant. Not because they are exciting, but because they are neutral. They carry no counterparty risk. They sit outside trade blocks. They are not liabilities on a sovereign balance sheet. Over the next 6 to 24 months, watch 3 indicators. Watch real yields relative to energy prices. Watch miner hedging activity and capital allocation discipline. Watch the ratio of paper claims to registered inventory in futures markets. If those indicators continue tightening in tandem, the thesis strengthens. If they loosen, the pressure dissipates. This is a strategic observation, not financial advice. Markets are complex. Outcomes are probabilistic. Positioning should reflect individual risk tolerance and time horizon. But ignoring structural shifts, because headlines feel temporary, has historically been expensive. The most significant repricings rarely feel dramatic at the beginning. They feel subtle. They feel like background tension. Until they don't. Right now, gold and silver are not screaming. They're signaling. The question is whether investors are listening before the signal becomes obvious to everyone. Because by the time it's obvious, the repricing is usually already underway.